So sitting here today, we've got about 150 million of equity that's undrawn and available to us. Our balance sheet is right in the middle of our target leverage range, which is 4.5 to 5.5 times net debt to EBITDA. And we've got no debt maturities until 2028. So we feel pretty good about our capital position and the ability to raise capital in the future.
With me today is Chris Constant, President and CEO of Getty Realty. Chris, thanks for doing the video with us today.
Thanks for having me.
How have you positioned your balance sheet in order to be the most effective and successful in today's markets?
Yeah, I think having a balance sheet that's conservatively leveraged is important for a net lease REIT. Demonstrating access to capital, given our lease structure and kind of the limited annual rent escalations that we have, is very important. One of the things I think we've done a good job of over the last several years is raising capital maybe ahead of when we need to deploy it. So over the last 2 years, we've raised just about 250 million of equity, all on a forward basis. And then in the fall of last year, we did a delayed draw senior notes offering of 125 million, of which we took down some of that this year. I think it's important for two reasons. Number one, it demonstrates to the market that we have access and can grow the business. And it also informs how we price assets from our acquisitions group internally at Getty. So sitting here today, we've got about 150 million of equity that's undrawn and available to us. Our balance sheet is right in the middle of our target leverage range, which is 4.5 to 5.5 times net debt to EBITDA. And we've got no debt maturities until 2028. So we feel pretty good about our capital position and the ability to raise capital in the future if we should need it.
And how active do you expect to be in the year ahead regarding acquisitions or dispositions?
So we've been very active over the last several years. I think over the last 5 years, we've deployed just over $1 billion of acquisition capital. This year, at the end of the first quarter, we announced that we have $110 million under contract at Getty. About 50% of that is in the automotive service category, in particular collision centers, which is a relatively new vertical for us. But probably I'm more excited that 110 million represents all of the asset classes that we invest in. So while it's 50% auto service, behind that is convenience stores and then QSRs and then some car wash assets as well. So I look ahead, I think we're going to deploy that 110 million over the next 9 to 12 months. And then behind that, we're continuing to underwrite across all of our industry verticals. And we anticipate being able to add assets to the pipeline as the year goes on. If I really look ahead into 26 and beyond, I think we're going to become a much larger business and much more diversified.
And what are you anticipating with respect to consumer sentiment and tenant demand in the short to medium term?
Sure, this is a question we've been getting a lot. I think we benefit at Getty from the fact that we inherited a portfolio of convenience stores from our founders. And what we've been able to do over time is add properties, diversify the company, scale it into a national portfolio that's in 42 states. But if you think about our portfolio, it's largely recession resistant. It's internet resistant. It's convenience stores and car wash and automotive service assets. And so we think we're positioned well for the current economy. We've gotten the question on tariffs as well. And I think with the potential tariffs on new car sales, right, our automotive service assets are in particular expected to benefit. With people holding cars longer, you could make an argument that washing your car is part of automotive service, and certainly maintaining it is more important than ever. And in particular, on the convenience store and QSR side of the business, I like to say we're the ultimate trade down. So before you were going to go out to dinner with your family and sit down at a restaurant, maybe today, because of inflation and because of maybe rising costs due to tariffs, you may trade down to just going to a fast food restaurant or even dining inside a C-store. So we like the positioning of our assets, and I think that we'll benefit over the next year or so.